Hello, this is SeeWing Yee from the Yee Real Estate Network. Thank you for attending. On this short video, I'm going to talk about, as a real estate investor, what are the criteria you need to look for in order to take action. Now, many of you are watching a lot of YouTube videos. Yes, the YouTube video platform uh, has, for a number of years now, have provided some great educational platform for many people, and in is a forum for education, creativity, and what have you. So everybody and their brother are doing YouTube videos, including myself. So it's an opportunity for all of us to just to have our message heard in the public forum. The public forum is really the whole wide world. So anyway, so I will have my take on it, and hopefully you would agree with my perspective. If you don't agree, that's quite all right. Everybody have their own opinions. However, my opinions come from years of experience, years of hard knocks, the school of hard knocks, doing the dirty work, doing the actual deals that really give somebody the credibility and the perspective, whereas an inexperienced or newbie does not have. So with that said, just a brief introduction. I own a real estate investment club here in San Francisco Bay Area almost 20 years now. So we have several thousand members, if you will, free members of our real estate investors that log in. They look at our free newsletter, real estate education, what have you. And we've been doing a lot of webinars, a lot of videos over many years. So we what we do is we help investors to buy turnkey out-of-state cash flow properties in different markets. As the market dynamics change in a particular market, in whatever part of the country we're in, then we have to adjust, we have to adapt, we have to go to different markets. And so each market we go to over the years, we create a team. What that means is we have a networking relationship with a market provider in a specific market where we network with someone. We have a referral relationship with various markets, whether it's in Austin or San Antonio, Texas, or Orlando, Florida, or Raleigh, North Carolina, or Cape Coral, Florida, or Birmingham, Alabama. So whatever relationship we have with those teams, we help turnkey real estate investors. Busy people, mom and pop people that have a regular full-time job and they want to venture into real estate investing. So we create a platform to help them invest wisely with very little work. We have done most of the research, most of the due diligence, and we pick the right properties for them. We have property management, the whole holistic approach, right? One-stop shop, the whole one umbrella. You go through our network, you go through our club. So as a free membership, we send you weekly newsletters to identify what properties that we can help you buy. I mean, we have done all the due diligence. We have the property management, the property has been rehabbed correctly, and we know the market. We know we can get the renter in. We do all the work for you. So turnkey, passive investing almost remotely, whether you live in California or you live in Minnesota, you live in Wisconsin or Vermont, you will have the ability to go into a market to buy a good that we vetted. We vetted each market. We vetted each of our team, and we've been doing it for so many years. So it works. Okay. So now you've been hearing, a lot of YouTube videos. They talk about investing. They talk about buying houses, but the majority of the YouTube videos, they talk about buying a primary home. Nothing wrong with that, right? For some home buyers or second-time home buyers, move-up buyers, people buy real estate to live, right? Owner occupy. And very few people, even in YouTube world, the channel world, you hear any guru, such as myself, talk about buying rental properties to rent the property out, right? So that's what we do. So this is my niche. I help out-of-state investors, regardless of where we live. If your particular market that you live in, for example, if you want to buy investment real estate, but the market you're in is too expensive, right? Then may not be feasible for you to buy in your neighborhood. So you have to go out there 500 miles away, 1,000 miles away, 3,000 miles away. It does not matter because the system and business model we put together is such that you have the ability to buy remotely because we have done most of the work for you. So, so as a home buyer, right, we all know, especially in the last few years, with the low inventory, with a high demand, and a historically low interest rate, we're seeing tremendous amount of appreciation, 10, 20, 30, 40% appreciation in just 1 year in some markets, right? So, everything is record-breaking, historic, acceleration, all these great buzzwords. And so, which is fine. The people, they take action, they make a lot of equity over it, not just in the past 2 years, long term. But the big, like I say it again, the biggest driver for home buyers is that low inventory, high demand, equals rising appreciation of homes everywhere in the country. Really, we talk about it, and lately, that's fine. You will hear some other YouTube channels that talk about real estate. They could say, if interest rate goes beyond 4%, whatever, we're gonna have a crash or a bubble or real estate market correction, whatever. And people talk about, on a mortgage payment between 3% to 4%, if you buy a $500,000 house or $800,000 house, the difference between a slight increase in interest rate can affect many buyers out there in terms of a loan qualification, in terms of affordability, right? We've been hearing that, but most of this chatter that we've been hearing are geared for home buyers, are geared for owner-occupied home buyers. But people that those so-called real estate gurus out there in the YouTube channel, they do not distinguish between home buyers, owner-occupied buyers versus real estate investors that buy those homes to rent it out. Okay, it's a big difference. So yes, when a home buyer or buying a house for $800,000 or $1.5 million, the difference between 3% mortgage interest rate versus 4%, still 4% is a historical low interest rate, right? It's amazing. The difference between payments are quite drastic. So that could impact someone's ability to buy a home based on the interest rate increase, right? Everybody get that? So I digress. So as a real estate investors, the interest rate, although it is important, is not a deal breaker if the interest rate is going from right now from 3.5% to 4%. And I'm going to prove it to you. So the metric, the idea that I have is that the risk investor look at cash flow. They look at, I'm not going to get into it too much, but they look at the rent to value ratio, 1% rule, or 0.07% of the purchase price. So if you do the multiplication, the 1% rule, if you buy a property for 100,000, you multiply by 1%, so equals 1,000. So that 1,000 should be the monthly gross rent. Well, if you can find a property for 100 grand, that's fine. If you buy a property for 250,000 as an investor, 250, 350K, that price range, that's a sweet spot, if you will. The rent to value ratio is around 0.07%. So 0.0% multiplied by 300 grand. So we're talking like $2,100. If you match up the rent to value ratio based on this formula, then you can have a positive cash flow. So it's all about, the icing on the cake is the positive cash flow. That would be make a good purchase for an investor. Does that make sense? So again, the risk investors choose a good market, a rising market, population growth, job growth, appreciation potential, migration, all those things that you learn about. So I'm gonna prove it to you. The difference between when you buy, again, when you buy investment single family home specifically, it could be could be a duplex, could be a fourplex, but let's focus on single family home since this is the main product. So so when you buy, I'm gonna give you a real example. This property, as you can see, single family home in Florida for $279,000. So so you look for cash flow, right? If you're able to rent this property for based on like 0.08% rent to value ratio, that means you can have a cash flow when you put 20 to 25% down payment. So the rent had to cover all your mortgage, taxes, insurance, and property management fee, and 2 or 3% vacancy factor, 2 or 3% or 5% maintenance factor, right? So forth and so on. So in this case, this is the ideal purchase. So if this example, you buy $279,000 single family home rental property in Florida, or could be anywhere, right? Could be in Texas or North Carolina, but $279,000, you're not going to find this single family home in other part of the country, not the Northeast, not the West, right? The single family home medium price of in the West is way higher than 279. So so for better or for worse, the ideal place to buy is somewhere in the South and Southeast. All right. So here we go. So this scenario, this pro forma cash flow analysis, if you will, is based on 20% down payment, right? 20% investment loan. For investor right now, the interest rate could be 3.7, 3.8 on a 30-year fixed rate amortized mortgage. Still a very good interest rate. In fact, it's still a historical low rate, right? I go back in 1980s. So you're 1980s. I don't know how old you are, but in 1980s, the interest rate is as high as 15% or more. And back then, people are still financing and buying properties, even at a whopping 15%. So right now is still amazing. So I'm trying to prove to you that even if the interest rate, the mortgage rate approach 4%, even low 4%, for investor, as long as your property still cash flow, this is a buying opportunity. Am I right? It's that simple. I'm trying to give you some elementary education, which I believe no one explained this to you. So the mindset and the triggering point for real estate investor to buy investment property is way different than the mindset for a owner-occupied property, right? So owner-occupied buyer, when they're buying $400,000 home, $800,000 home, or $1 million homes, the interest rate matters, okay? But investor, no, interest rate is not a primary motivation to buy. As long as the price of the house is good, the rent that you collect will exceed all your debt, monthly obligations and expenses, equal positive cash flow at the end of the day. Of course, we all want lower interest rate. If even a lower interest rate on a small purchase price, such as in this example, you can have a slightly higher cash flow. It's not that big of a difference. Cash flow, is a good purchase, but the way an investor would determine the viability of a property is long-term return. So on a systematic basis, you calculate the overall return in terms of equity appreciation and the tenant paying down your mortgage, and your payment never goes up because it's a fixed 30-year mortgage, whatever, and then you can get hopefully increasing rent in the future, so you have more cash flow than you think you might have at the beginning, right? So this is so at the end of the day, 20% down payment at even at 3.9% mortgage rate based on the rent. The rent is like $2,100 right here. Yeah, and the numbers make sense. At the end of the day, we get a financing 20% down to 3.9% interest rate. you have a positive monthly net cash flow of $434. So this is a good purchase, assuming everything else being equal. But now let's pretend like later on in 2022, the interest rate for investors, that is, investor interest rate is slightly higher than owner occupied interest rate, right? So so now let me prove to you, since you agree this is a good purchase, let's change the interest rate. Let's pretend, worst case scenario later on this year or beginning next year, 2022, 2023, the interest rate becomes, instead of 3.9, let's say I'm going to change it to 4.2, right? Let's look at the cash flow, because the investor, interest rate is not a deal breaker. It's not a major red flag, as long as the other areas of the cash flow analysis makes sense. Okay, I'm switching to 4.2, which on at first glance you think 4.2, no, I will never buy a rental property with a higher interest rate of 4.2. No, hold tight. Okay, so I'm gonna recalculate at 4.2 interest rate. Let's go over first year projection. Look at this. Decrease is only like $40. I'm not sure. See here, 4.2% interest rate from 3.9 to 4.2. I mean, under worst case scenario, the next 12 months, we don't know the interest rate, then the monthly net cash flow is still very attractive. It's $395. So when you buy an investment home, the purchase price is not that high, right? Relatively speaking, compared to a regular home buyer, owner occupied buyer. So it's only the difference between 3.9, 4.2, 3 percentage point is only like $40 cash flow difference monthly. It's not a deal breaker at all, as long as you buy in a good market, good neighborhood, and good long-term equity appreciation. So risk investors, that's what you look for. All right, I think that is all I have to say. I think I stated my case. Okay, so you buy for long-term growth as a risk investor. You buy a property where the rental value ratio makes sense, 0.07%. Cash on cash return is 10-15%, and the total return, if you project the first year appreciation at a mere 5 to 7%, you're gonna get your down payment back within the first 1 to 2 years. So, okay, hope this helps, and that's all I have to say. So, yeah, look at various analysis, various criteria you put upon yourself, but the interest rate change in it by itself should not be a deal breaker if you are a real estate investor. All right, thank you so much. Hope this helped with you to continue to help you buy rental property for your financial wealth. Thank you so much. This is SeeWing Yee from the Yee Real Estate Network. Have a nice day. Bye-bye.